Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I am your host, Christopher A. Paniotu, certified financial planning professional, the Cap in Capitalize. And on today's episode, we are going to get into how to deal with variable income. But as always, before we do so, the free tip of the week. Actually review your tax return. Now, I know tax season is over, and the last thing you want to think about is tax season, especially if you owed money, okay? However, this is the best time for you, because it is fresh in your mind, to actually take your tax return. I know this is going to sound boring, and you're going to probably bleed out of your eyes while doing this. But if you read through your tax return, it's not going to take you that long, maybe 5 to 10 minutes. If you have a more complex situation, obviously a little bit more time. But the point is, just by doing that, you will discover very quickly what you can do for the next year, in this case, 2025's tax season. So if you had extra cash flow, were you able to put more into your 401k, but you didn't choose to do so? Would it have made sense to contribute to an individual retirement account or a Roth individual retirement account? Do you have access to a health savings account if you have a high deductible health plan, but you didn't use it at all? Like, there are a ton of questions that you can answer simply by looking at your tax return. And you will thank me in the future when you save, in many cases, hundreds of thousands of dollars in taxes you won't have to pay. Now, we got that fun, free tip of the week out of the way. So let's get into this exciting and also slightly tricky episode on how to deal with variable income. So the first thing I want to talk about is creating a flexible budget. And there are a couple different flavors of budgeting when it comes to having a variable income. You can use a zero-based budget or an irregular income tracker. Now, for me, I want to caution you with using these types of tools, or what I'd call fixed strategies with variable income. So if you're like me and you're hyper focused on the number side of things, using these tools will actually be a burden to you, as you're going to get way too obsessed with the minute details. A quick little tangent: I used to use a Whoop for my fitness tracker, and I love Whoop. I love what they're doing. But for me, I had to actually take a break from Whoop because I was so obsessed with making sure I got enough REM sleep. If I took a nap, I wanted to make sure I got a zone 3 sleep. If I was working out, I wanted to make sure that I got into the proper zones. My blood sugar levels were balanced accordingly after every meal. I got so obsessed with that I forgot the qualitative aspect of just living my life. So it was actually a detriment to everything that I was attempting to do, excuse me. Now, back to the task at hand. I've personally never used an income tracker. And instead, what I do, and I actually do this for clients, is I give either myself or the client the ability to give me a rough range of what the client is actually going to spend. And I actually do this for me and my wife on a given month. So an example would be, let's say that you spend $4,000 to $5,000 a month. You got to give yourself that range. Now, what I like to say with that, so let's go off of 4,000 to 5,000. Anything above and beyond that number, which again, if you're going to use that range, in this case 4,000 to 5,000, you want to go off of the high number, because if you don't actually spend as much, that means you have that much more to go and capitalize, pun intended, on future things, whether it's investing, paying off high interest rate debt, et cetera, et cetera. So it's a much more intuitive understanding of your money. Now, going further, let's say that hypothetically, again, you spent $4,000 to $5,000 a month, but you earned about $8,000 a month. Now, for clients, what I would say is take whatever you have above and beyond that. So if you make $8,000 a month, but you're spending $5,000, okay, that gap money, which is what we talk about in the books a lot with profit every month of $3,000, how much of that should you put towards prudent use? Meaning the obvious, the 401ks, the IRAs, the investment accounts, maybe life insurance if you don't have it, things of that nature. And then anything left over out of that $3,000 a month. So let's say you say $2,000 a month is going to prudent use. That remaining $1,000 is just free cash flow. That just goes to whatever. That's your fun money, which I actually hate that term because I think every dollar should be put to prudent use, but you get my point. Now, if you have irregular cash flows, which is the purpose of this episode, always assume you're going to spend more, again, with that range, and maybe even give yourself a little bit more of a bump. So instead of $4,000 to $5,000, maybe even $5,500 a month, even though you know it's that $4,000 to $5,000, because you want to have that cushion for if you have a slow month or two, or maybe a year, if you're in a really volatile industry. And not only is that the prudent thing to do from a financial standpoint, it's also from a behavioral finance perspective, it'll build the subconscious emotional cushion in your mind. Now, another thing I want to talk about when it comes to the flexible budget is prioritizing fixed and essential expenses. And this is mission critical. First, you've got to start with your fixed expenses. And these are the ones that you absolutely cannot ignore. We're talking mortgage, rent, taxes, water, utilities, food. You can give yourself a little range for groceries because I get there's variability with that, but things that you cannot avoid. Now, as a side note, if you don't know how much you spend on a monthly basis and that's really overwhelming, a general rule of thumb that I like to use, and it's not perfect, but it's a good place to start, is you take whatever your mortgage or your rent is, and you multiply that number by 2 to 2.5 times, depending on how many mouths you are feeding and how big those mouths are. Okay, so like I'll use an example. If it's me, my wife, and our 2-year-old and a little bit older daughter, all right, well, she's She can put down some food for her age, okay? And me and my wife like to eat out too. And so, we would probably go toward that 2.5 times. If you are, single, you're really conscious on budgeting, you've only got your mouth to feed, your expenses are relatively low, you could probably get away with that 2 number, maybe even a little bit lower. So, but just give you something to think about. Now, when you do that, that's going to give you a solid idea on how much you are roughly spending per month on average, unless you really need to capitalize on your expenses because you're spending out of control like a drunken sailor. But for the majority of you that are tuning into this podcast, you're probably a little bit farther ahead than most people in the world of understanding expenses and in managing your finances accordingly. Now, another thing I want to talk about is building a buffer. And with variable income, this is infinitely more important than a stable income. One of the things I want to talk about is a larger emergency fund to cover income gaps. Now, I first got to give the general rule of thumb. So, and for those of you that are returning to the podcast, you've heard this a number of times. For those of you that are new, first off, welcome. And then second off, if you don't know how much money you need to have in your checking account, generally speaking, that is a month of expenses. So if we go off of $4,000 to $5,000 of expenses per month, money in, money out, you could probably get away with $4,000 just floating in your checking account. Once you have that, 3 to 6 months of savings is going to be plenty. Again, I recommend you're going to want to look into an online savings account to get a juicier return on your money. That's just going to sit there anyway. I'm not going to bore you into the details as why I would prefer an online savings account. We've talked about that on past episodes a ton. But the point with that is, depending on, that variability of, if you're single, if you're running your family's finances and you're the only provider, whatever the case may be, 3 to 6 months is generally good. However, if you are in a commission-based business or you run a business with lumpy cash flows, I can make an argument that as an employee in those businesses, you could maybe need as much as 9 months, maybe even a year. I actually work with business owners where they have up to 2 years of cash flow in their business. Now, do I think that's a little extreme? Yeah, because even though times are tough, I've yet to see a successful business go a year without getting any type of revenue. But the point is with that is you want to have a little bit larger of a buffer. Okay. I don't know if that was the most grammatically correct English that just came out of my mouth, but we do it live. Now, another thing you want to talk about when it comes to a buffer is prepaying expenses during high income months. Now, I've heard this strategy before, and in theory, it sounds just like the absolute right thing to do, but there are a couple caveats because it really depends on a number of factors. It depends on the industry you're in. It depends if these expenses are attached to high interest debts, things of that nature. Sometimes you simply can't get around certain expenses. So if that's the case, you've obviously got to pay them down. Like right now, as we're recording this, we got in the mail our property tax notification. And if you're just listening and you're not watching, I was grinding my teeth in a very uncomfortable smile when I got that letter. Okay. But the point with that is I can't get around that. And so we're going to just have to rip the Band-Aid off, pay that sucker. Is it fun? 10 out of 10 times, it absolutely sucks at a massive amount. However, you just get it done, you move on. One thing that you need to know, and this is regardless if you're an employee or a business owner, you need to understand your situation. And so if you know that in the coming months, you're going to have a larger income stream. Maybe you're a real estate agent and you know that commissions are coming in. You're going to get this fat influx of money because it's on the dotted line. You're just waiting for the money to settle. That's always a really fun place to be. You may want to use those dollars and have in your mind, okay, yes, I'm going to get this fat lump sum of money, but I already have this allocated to, again, high interest debts, 401k, things of that nature. And that's going to be valuable because then even in the lower months, you're not going to have that pressure of, oh my gosh, like not only do I have this lower month, but I still have this huge debt or huge outlay of expense hanging over me that I still need to take care of. It's just become a needle in my side, things of that nature. Now, another thing you need to think about is paying quarterly taxes if you do pay quarterly taxes. If you know that your income is going to increase as the year progresses, even though your CPA may tell you to skip a payment, know your situation and pay it forward. This actually happened to us last year. For those of you that have read my second book, Capitalize Your Sales, I detail that we had a record-breaking year in revenue and all that fun stuff. And up until August, our CPA, who's phenomenal, was saying that, you could probably get away with not paying your quarterly in September. Now, as well as he knows our situation, he doesn't know the business as well as, frankly, I do. And because it's my business, it's not his business. And I knew September, October, November, December were going to be massive months, which they were. And I'm really glad that we paid those quarterlies in September and January of 2025, because even with all of that, we still owed a fat chunk during tax season. And it was very painful. It was not fun at all. I kind of knew it was coming. So we obviously allocated for it. But the point is, I can tell you firsthand, you don't want to skip those quarterly payments. And then going forward, if you know that you're going to have a better year, really stress that to your CPA. And it's okay if you overpay a little bit. on the tax side of things, because then you can just roll it forward until those taxes are exhausted. And that is something that I wish more people knew. Again, I'm not a CPA. I'm not an enrolled agent. That's not, direct tax advice. That is just me speaking from experience, because 10 out of 10 times it's going to suck when you pay taxes, but I would much rather have you pay less come April 15th than look at your statement. You've paid all these taxes in, and then you got to add even more to the fire. It's not a fun conversation. So we're going to take a quick commercial break. And then when we come back, we're going to go over income smoothing strategies on how to deal with variable income. Stick around.
Are you ready to transform the way you approach sales? This episode is sponsored by the second book in the Capitalize series, Capitalize Your Sales, the all-in-one sales framework that saves you from ever struggling again and teaches you how to sell with sincerity, which dives deep into the art and science of driving sustainable growth. Packed with strategies that go beyond surface-level techniques, this book will help you understand what it takes to truly connect with clients, build long-term relationships, and close deals. Whether you're looking to fine-tune your sales craft or break through to the next level, Capitalize Your Sales offers a roadmap to success designed for today's fast-paced business world. Head on over to your favorite bookstore, order today, and start capitalizing your sales immediately. And now, back to the episode.
Welcome back from the commercial break. Let's get right into it and talk about income smoothing strategies regarding how to deal with variable income. Now, a lot of people talk about automating savings when income is high. And if you have variable income, automation can be extremely dangerous because it's not going to match your variability. I mean, by definition. Where I will say this comes in handy is back what I said before the commercial break, when with knowing your free cash flow, or what we call gap money for those of you that get intimidated with business terms. If you have a nice margin of safety in monthly free cash flow, it's safe to automate some of that to savings, retirement plan contributions, et cetera. But don't make automation the end all be all. Because what ends up happening, I'm going to go off a little tangent here, but I promise it won't be too long. When you get used to automating everything, you really have no active understanding about anything. I could argue with everything in your life, but when it comes to money, you lose that dynamic understanding of being nimble in the mind when it comes to your money. Because money is not a fixed thing. It is very dynamic. It's very fluid. And you've got to be on top of that because times change. And so with that, if you're just automating everything, what made sense to automate 5 years ago may not make sense today. So even though you do automate, you have to have you have to be actively engaged in the understanding with your money. Now, on top of that, with income smoothing strategies, there's the whole concept of allocating a percentage of every paycheck to future use. And it's similar to what I just mentioned. However, it's like I said, it's a more proactive mental model on the future of what your income situation is going to look like. And so even though, again, it is automated, it gets you to be more active in your future. So you remove that, even though the automation is there, you remove the automation of just like shutting off your mind. And again, you want to be cautious with the margin of safety with your cash flow with variable income. Because if you get too close to that and maybe you go over and then you have to go backwards, then you've defeated the entire purpose of automation in the first place in setting yourself up successfully in the world of finance. Now, let's talk about tax management. Again, I talked about it a little bit before the commercial, but we've got to come back to it. Saving for your quarterly taxes to avoid penalties. So let's dive into this a little bit more. Let's say that you pay quarterly taxes of, and I'm going to make this up, $5,000. So January, April, June, and September. And as a side note, I don't know why the IRS has those as the quarterlies because it doesn't really add up to every quarter. But again, that's beyond my pay grade. Let's say that in July, you get this huge commission check or this bonus, whatever the case may be. And you can set aside that cash in your online savings account to have your quarterly taxes locked and loaded for basically the rest of the year until next tax season. If that's the case, do it. And this also applies to your 401k plan. So let's say that your goal is to max out your retirement plan this year, which in the year of 2025, it's $23,500. If you are younger than 50, $31,000. If you are over 50 and between ages 60 and 63, you are lucky that you can contribute $34,750. Okay. I don't know why Congress put that in, but again, they don't return my calls. So I'm just the messenger. So if you get a quarterly bonus or have a large commission or a sale, why wouldn't you, all things being equal, use that money to front load your 401k to maxing it out for the year? Now, I understand this is very confusing for a lot of people because conventional wisdom says you want to invest on a monthly basis, you want a dollar cost average, and there are plenty of research articles that actually back that investing on a monthly basis versus lump summing at the beginning or the end of the year, it's actually more beneficial from an investment standpoint. However, with those gifts of financial fortune and these lump sums, generally speaking, if you're able to max out your 401k or 403b or 457b or simple IRA or whatever your business has, that's not going to be your only source of retirement income. And in some cases, I've even met people where they make so much money that their 401k, they may not even need to spend it ever in retirement. And that's a whole nother story. But the point with that is, if that's the case, what is your main purpose of your retirement plan? It's tax strategy. It's tax avoidance. And so by making sure that you maxed out your retirement plan that much sooner in the year, it's one less thing for you to do. You have free cash flow for the rest of the year if you're an employee, because your company will know that, hey, I can't put in more than what's already been put in due to the age limits and income and dollar constraints. And so then later in the year, you have that much more free cash flow where you can either pay down high interest rate debt, you could pay, you could do a backdoor Roth IRA conversion or an individual retirement account contribution. You can max out your HSA. If you have not only high interest debts, yes, you could pay those down. You could go and invest that money. Like you could have extra money for Christmas. Like there's so many different options in tools and tricks that you can utilize by maxing out your 401k earlier in the year. It is not constrained to doing it equally. And in fact, some clients that we work with, I actually recommend, hey, from January until you max out, put 100% of your paycheck into your retirement plan, because by the time you max that out, you've got more than enough cash off to the side where you can live off of that. And by the time that dwindles down, your 401k is maxed out. It's one less thing to worry about, and you ride off into the sunset. Now, you're also going to want to track deductions to maximize refunds. Now, this piggybacks off of the 401k example I just mentioned. Even though you may have variable income, your deductions that you can take every year are pretty cut and dry. So, if you had free cash flow, like I said, could you have maxed out your 401k? If you have an HSA account, could you max that out? Did you even use it? Would it have made sense? This is a little different from what I said earlier, to put extra cash aside into an IRA or a Roth IRA or do a backdoor Roth IRA? Do you have high interest rates that you could pay down? Did you file your taxes appropriately if you are married? That is a big one that a lot of people misunderstand. I'm not going to go into more possibilities, but understand your deductions when it comes to variable income. Because if you're not hitting, this is actually above and beyond variable income. If you're not hitting all of the easy wins in the world of finance, you are doing yourself an immense disservice. And I've told people this so much in the past. If you're a millionaire, no one's going to ask you, yes, they might ask how did you make it as far as business or investment strategy, but you can make the argument of, the fact is, I'm worth this. I didn't do it in a sexy fashion. I didn't create the next grandiose company. I didn't hit it big with the next investment. like the next Amazon or whatever the case may be. I just did it by hitting my deductions. I took every free dollar I had and made my money work for me. I utilized the tax code to the best of my abilities. And just by doing that alone, like, it's not hard today. In fact, I could argue more so than ever before to become a multimillionaire just by doing that alone. Now, let's talk about mental and emotional tips when it comes to variable income. So a lot of people ask me, okay, how do you cope with the stress of unpredictable income? And I don't want to sound like a broken record with this, but it does relate to what I mentioned earlier in this episode as far as getting your money to work for you as soon as possible. So the most straightforward way for this emotion to completely evaporate is to have your portfolio pay enough income to pay for your lifestyle, even if you were unemployed for a significant period of time, or just didn't earn a check in the first place. And this is also why having a proper emergency fund built up is mission critical, as it solves both the academic 101 as well as the emotional stability dilemma that you may or may not have. Also, as a quick side note, if you've got that money saved up in an online savings account, again, is it going to earn you a ton of money? No. But let's say that you've got 6 months saved up, you spend $5,000 a month, that's 30 grand. Well, 30 grand times with interest rates right now, let's say it's, what would it be today? I think right now interest rates on online savings account, let's call it 4%. Okay. So every year, your savings is earning you $1,200 on really just interest. And you're not doing anything. Well, what if you took that $1,200 every year? Because by definition, you don't need anything more in your savings, assuming you don't have short-term needs like down payment on a car, home, things of that nature. What if you took that $1,200 and invested it accordingly into an individual retirement account or a Roth IRA for 30 years at a 7% rate of return? That is going to turn into hundreds of thousands of dollars. And you didn't even take your money to go and do that. Your savings helped fund your retirement. That's pretty cool. And trust me, that will solve the emotional instability that you have very, very quickly. Now, we've talked about free cash flow allocating to your 401k to make sure you get at the very minimum the match, and assuming there aren't any high interest debts. We talked about online savings. Once you have all of that, what's cool is you don't really need to recreate the wheel and get super creative and custom. We've talked about investing, whether it's in the stock market or private equity or real estate. I've talked about the endowment model in my book on our show in the past. I'm not going to get into the weeds of that because regardless of what investment strategy you choose, as far as long-term growth is concerned, the point is anything above and beyond that when it comes to that conversation, that's kind of just the cherry on top as far as emotionally how you relate temperamentally, to what investment strategy makes the most sense for you. Okay. Now, the last thing I want to talk about is planning ahead for the slow seasons in your industry. So I've kind of mentioned this earlier, but I've talked a lot more technically in this episode. This is not a technical way to close out this episode. This is much more of a know thyself conclusion. As much advice as I can give you, or anyone that you choose to listen to, being your CPA, your tax attorney, friends, family, parents, other influencers, even though you're listening to the right one, that's beside the point. You will know your personal situation in your industry and your business, if you run a business, more than anyone. And if you don't, very dangerous. But most of you do. You understand your situation more than anyone. So by knowing your situation, sometimes you can't even explain it other than just the gut feeling, or you've done it long enough where you just know. It's the mental muscle memory of your profession. If you see a slow season coming in, or a slow year coming in hot, make sure, all things being equal, you prep that much harder to have your emergency fund, or even above and beyond your emergency fund, your expenses set up. Because I'll tell you what, it all compounds. If you've got all that set up, you're emotionally more stable. When you're emotionally more stable, you make better decisions in business, and you probably get more sales anyway. And then when you make better decisions in business, you're investing at a higher return on invested capital, as well as closing more business and sales, which will further compound your wealth and success, which will make it that much better for you in the long run. So that does it for today's episode on how to deal with variable income. Had a lot of fun writing this one. As always, you can hit me up on various social medias and capitalizepodcast.com. But until next week, as always, I'm your host, Christopher A. Paniotu, certified financial planning professional, the Cap and Capitalize. And until next week, keep capitalizing. Take care. As always, thank you for joining me today. If you have questions about today's episode or any personal finance questions, please reach out to me at Cap and Capitalize on Instagram, Chris at capitalizeyourfinances.com, or via our website, capitalizepodcast.com. If you want more Capitalize Your Finances content, head on over to capitalizepodcast.com and check out our blog, free resources, book, and online course. As always, I'm your host, Christopher A. Paniotu, certified financial planning professional, the Cap and Capitalize. And until next time, keep capitalizing.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice. There's no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount of the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you're required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Christopher Paniotu is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. Capitalize Your Finances LLC is a separate entity from LPL Financial. Capitalize Your Finances is not registered as a broker-dealer or investment advisor. CRPS conferred by College for Financial Planning. LPL Financial California Insurance License Number 0518721. LPLIA California Insurance License Number 0B91442.